A troubling trend is brewing in the U.S. retail sector. Big names like Walmart, Dollar General, Home Depot, Kohl's, and other retailers are canceling billions of dollars in orders for this holiday season. The last time this happened was in 2022, right after interest rates started to rise. Now, a much deeper issue is forcing major corporations to cut back on imports, even as we approach the busiest shopping season of the year. This begs the question, what do these companies know about the direction the U.S. economy is headed that the rest of us don't? Let's investigate this together in today's video. But before moving on, please give us your support and leave a thumbs up in this video and subscribe to our channel so you stay informed with the latest news. It seems that things have been turned upside down in the retail industry over the past couple of years. Not long ago, companies were reporting record profits and they were rushing to stock up enough goods to meet consumer demand. But in 2024, retailers have been reporting sluggish sales and weaker than expected financial performance. Now, they are calling off a massive number of orders, leaving experts and economists alike worried about the reason behind such extreme decisions. The holiday season is the time when consumer demand typically peaks. Under normal circumstances, this move wouldn't make any sense. But it's safe to say that current economic conditions are far from normal. At the moment, Americans are struggling with the highest cost of consumables and basic services in recent history. Pretty much everything has gone up in price over the past few years, but people's incomes have not risen accordingly. So, consumer spending is falling precipitously at a pace most economists wouldn't expect for this time of year. In fact, holiday retail sales this year are projected to have the slowest growth since 2018, according to a national retail forecast. The largest retail trade group in the United States said last week that it expects sales growth to decline by 3.5% compared to a year ago. The forecast considers economic indicators such as employment, wages, consumer confidence, disposable income, consumer credit, and more. Even though interest rates have come down, the damage they cause to people's purchasing power will have long-lasting effects. Consumers do have those interest rates and the lingering inflation on their minds. So we expect that consumers will continue to be more price-conscious and pragmatic in their spending decisions, National Retail Federation CEO and President Matt Shea said during a call with reporters. This is forcing many big companies to cancel orders and import fewer goods as they brace for another bleak shopping season. Reuters reported that Walmart, the world's largest retailer, has shipped 340,000 kilos of products described as holiday goods into the U.S. in the 12 months ended September the 30th, according to data provided by Import Yeti. That amount is less than half the 980,000 kilos shipped in the same period last year. And in 2022, Walmart imported more than 1.9 million kilos of holiday products in the same period. Charles Sizemore, Chief Investment Officer at Sizemore Capital Management, highlighted that if retailers are ordering less, they're expecting sales to fall significantly in the fourth quarter. This also means that store shelves will look emptier and some inventory holes will not be filled in time for the festivities. Dollar General and Home Depot have faced their fair share of challenges this year anyway, with declining consumer demand dragging sales down and leading to store closings, as we've mentioned before on this channel. Meanwhile, Walmart is trying to lure customers by offering discounts and deals. The company's average price point for toys is $40.16 this season. That's 10% lower than last year. But even that might not be enough. Once again, retailers are afraid they will end up stuck with excess inventory they cannot sell because consumers simply can't afford to make as many discretionary purchases as they could in the past. Kohl's executives said last week that shoppers, particularly those in lower income brackets, will feel more squeezed than a year ago. Christy Raymond, Kohl's chief marketing officer, said the cumulative impact of high prices on food and other essentials is eating into people's savings. As companies aim to slim down expenses, they're also expected to hire fewer holiday workers this year compared to last year. Many retailers are indeed anticipating lower revenue and profit margins compared to previous years, primarily due to lingering inflation and high consumer debt. Michael Barbera, Chief Behavioral Officer at Clicksuation Labs, that's the marketing agency focused on consumer psychology, told the Post. But these factors alone do not explain the full picture. What is really prompting retailers to cut orders by almost 50% right now? The answer is simple, but it's not easy to swallow. They're thinking about the longer term. Although we want to believe that the inflation nightmare may soon be gone, its impact on the buying power of everyday Americans will linger for many years to come. A survey conducted by EY Shopping revealed that 56% of U.S. consumers are concerned about being able to pay for this holiday season. Wallets are still squeezed, making shoppers more intentional with their purchases. Greg Zakovich, a senior e-commerce expert at Omnisend, noted in a recent interview, even worse, about 2 in 5 credit card holders, or 37%, have either maxed out a credit card or come close to doing so since the Federal Reserve began hiking interest rates in March 2022, according to a new online survey by personal finance firm Bankrate. Inflation does not care if you are rich or poor. Everyone can feel its wrath, Bankrate analyst Sarah Foster said. With limited options to absorb those higher costs, many low-income Americans have had no choice but to take on debt to afford costlier essentials, at a time when credit card rates are near record highs. Retailers' preventative measures are not just considering this holiday season may be a fiasco, but the fact that it'll take years for people's incomes to catch up with the cost of basic necessities, such as housing, rents, and energy. And until then, sales of non-essential items will continue to drop. An analysis by LendingTree found that 76% of Americans say inflation and the current economy make it more difficult to afford their bills, and 40% of Americans say they're less able to afford their monthly bills than a year ago. Angela Russell, an Ohio resident that works for the CDC, is just one amongst millions, saying the grocery store is just outrageous right now. But it's not just that. Everything has gone up. Clothing, my insurance, she said during an interview with CNN. The pressure is real. Everything is so much more expensive than it was 4 years ago. It's astronomical what you're paying, Russell emphasized. In 2024, the typical household is spending $925 more every single month to purchase the same goods and services as just 3 years ago, and that's according to Moody's Analytics. We can talk all day about how inflation is moderating, but the cumulative impact of several years' worth of inflation has done a number on household budgets, stressed Greg McBride, Chief Financial Analyst at Bankrate. The view from 35,000 feet is that unemployment is low, the economy is growing, and people are spending money. The reality on the ground is moderating inflation does not mean prices are coming down, just that they aren't going up as fast. Many have seen their buying power eroded. Even if your income has kept up with prices, you're just treading water, McBride noted. To get by, significant shares of Americans are being forced to look for additional income sources and cut down on gasoline purchases and groceries. A CNN poll showed that 35% of U.S. adults say they've recently had to take on extra work just to make ends meet, and 69% have been driving less, while 68% changed their grocery buying to be able to make ends meet. So, how are cash-strapped Americans supposed to support U.S. businesses if they can't consume as much as before? That's the reality many retailers and other businesses are having to come to terms with right now. The economic destruction caused by the government and the Federal Reserve cannot be fixed from one day to the other. It'll take several years for Americans to recover their financial health. That's why we continue to see big industry names going bankrupt or closing thousands of stores to be able to survive. The last casualty of the retail sector is Walgreens. The pharmacy chain announced plans to close 1,200 locations as it scrambles with declining foot traffic at stores and disappointing sales numbers. Chains like Walgreens, which once snapped up prime retail space in towns and cities across the country, are now in retreat. They've been battered by shrinking prescription reimbursement, persistent theft, rising costs, and consumers who have strayed to online retailers. The boost they received from taking the lead on vaccinations during the COVID-19 pandemic has long since faded. The company's announcement last Tuesday comes as rival CVS Health conducts a plan to close 900 stores, and Rite Aid slashes to about 1,300 locations to be able to simply re-emerge from bankruptcy. The situation is becoming so dire that even Morgan Stanley believes a downturn is on the horizon. Business Insider just reported that the bank pointed to major risks looming over the economy. As more and more layoffs continue to be announced, if the economy slows down even further in the coming months, they could snowball. And that's usually what contributes to a recession. A slowdown, then more people get laid off and spend even less, the economy slows down more, and it snowballs, said Seth Carpenter, the bank's global chief economist. Moreover, another weakness that could push the United States into a severe recession stems from possible tariffs after the presidential election, with the elected president vowing to impose a 10% tariff on nearly all imported goods and a 60% tariff on imported Chinese goods. Though the measure aims to strengthen our domestic industries, valuing what is produced in America, and decreasing our dependence on imported goods over the long term, in the short term, experts said it can fuel more inflation and raise prices for consumers even more. Tariffs could also result in higher prices for goods that producers need in industries like manufacturing. That could lead companies to produce less or invest less in production, another thing that could spark a deep slowdown. But let's just hope we're in better hands now. Something has got to change in 2025, or we will see many more order cancellations by retailers and store closings with layoffs and bankruptcies. The problem is that so much harm has already been done, and we must wonder, is the U.S. economy beyond repair? What are your thoughts? We look forward to reading your feedback, and thank you for watching.